Hello and welcome to Options in Plain English. Today we're going to be talking about maybe one of the most widely used types of options configuration, the vertical spread. And in particular, today we'll focus on credit spreads, short call spreads, and short put spreads. A vertical spread is a very versatile options tool because it allows you to clearly define max profits and max losses on top of reducing the buying power reduction when compared to selling options outright, allowing you to trade very expensive underlyings which you wouldn't have access to otherwise. Let's start by analyzing what happens when you short a call. So when you sell a call at a certain strike price, what you're going to have is you're going to have a credit that you're going to get upfront, and then you're going to have unlimited exposure because you're going to start losing money as the stock price starts going above the strike price that you sold, and the stock price can go very high. In fact, with no limit, so you have unlimited risk for this position. So what's going to happen if at a strike price that's a little bit higher than the strike price that you sold, you decide to buy a call. So now you have a long call at a strike price that's higher than the original strike price that you sold. In this case, you're going to have a credit that's going to be less than the original one because now you had to buy the call, but you're not going to be exposed on the upside to unlimited risk because when this long call starts kicking in, you're going to cap your losses on the upside. Okay, this position is called a short call spread, and it's a vertical credit spread. This position is made up of two legs, a short out of the money call at strike price KS, and a long out of the money call at strike price KL. In this case, the max profit is going to be the credit that you receive when you put it on. So the short call premium, CS, minus the long call premium, CL. The max loss is going to be the width of the spread minus the credit that you got. Because if the price expires over here above the long call that you bought, this is sometimes referred to as a wing, so a protective wing. So if it expires above the long call, you're going to have the max loss being equal to KL minus KS. But because you received the credit up front, your loss is going to be reduced by that amount. Your break even is going to be where your short strike price starts kicking in your losses because you're going to start reducing the value here of your position, meaning that this call is going to start gaining value. So you have that point, but you have to add the credit that you received so that the break even is pushed higher by the amount that you received initially when you put the position on. So this is the expiration line. This is what a short call spread looks like. And the dashed line is at any time prior to expiration, the profit and loss line is going to look something like this, where it starts approaching the expiration line, but it only actually reaches it at expiration. So this transaction is initiated for a credit on a single transaction. So you don't need to put it on by first selling a call and then buying a call. You can do it in a single transaction. It's going to be a short call spread or selling a call spread. It's going to have the same expiration and the same number of contracts. This is a bearish position. Why? Because if the price goes higher, then you're going to lose money, and if the price goes lower, then you're gonna keep making money, or at least hang on to the credit that you received. So this is why this is a bearish position. You want the stock price to go lower. This position is closed with a buy to close order on a single transaction. Same thing as when we initiated it. You don't need to sell the short portion, and then sell the long portion. You can sell the whole spread at once. you can also, if you would prefer it that way, you could leg out of the position. You could close the short call or the long call separately. But in this case, for this lesson, we're going to look at the spread as a unit and as something that we open with a sell to open transaction, and we close with a buy to close transaction on the whole spread. But you could also treat those legs independently. The Greeks will be partially offset because of both legs. So if you were to just sell the short call, for example, you're going to have positive time decay. So time decay working in your favor, because this, as time passes, this position is going to start losing money. But at the same time, you're buying a long call. So in this case, that position is going to start losing money as time passes. So both together are going to have their Greeks offset. And because of this, the Greeks are going to be much less than they would be if you were to buy a call or to sell a call separately. At expiration, we're going to talk about at expiration. If it expires out of the money, which would be in this area, anything that's below the strike price of the short call, the spread is going to be worthless. So you're going to keep your max profit, which is going to be the credit that you received. If it expires at the money, which for spreads is considered anything that's between KS and KL in this case, so anything that's between the short and the long legs, you're going to be assigned on your short call. So what's going to happen is if the price expires here in between, your short call is going to be in the money. So you're going to be assigned a short position in the stock. Or if you're covered, if you have the stock, you're going to be selling those shares at the strike price. Okay. If you don't have the stock, then you're going to have to be assigned a short position in the stock. If it expires in the money fully, so the price expired over here, then you're going to be assigned here, but you're going to be able to exercise your long position, and you're going to have to be selling at this price and buying at this price. So you're going to realize a loss that's going to be the width of the spread. But since you received initially a credit, your full loss is going to be equal to the difference between strike prices, so the width of the spread minus the initial credit. But you're going to be assigned, and then you're going to exercise your position. So we have a few advantages for this spread. The advantages are that it's a clear max profit and max loss. You have positive time decay because your short call is going to be bigger than the long call because it's going to be closer to the at the money. It's closer to where the price is. So you're going to have positive theta here, positive time decay, and then negative time decay here, but this one's bigger. So time passing is positive for you. This position is going to give you access to expensive underlyings, which you probably wouldn't be able to access if you didn't have a position such as this. And there is no need for the highest level of approval for options trading. In this case, you would need you don't need to have permission to trade naked options because none of these options you're selling naked. So because of this, you don't need the absolute highest approval level to trade these kinds of spreads. Now we're going to look at a different position. We're going to be selling a put. So this is a short put. You sell a put at a certain strike price. And now you're going to be receiving a credit. You're going to keep that credit. That's going to be your max profit. But you're exposed on the downside all the way to zero. So in order not to have the full exposure on the downside, you're going to be buying a long put that's going to be at a strike price that's lower than where you sold the put. In this case, what you're going to have is you're going to have a credit that's probably going to be less, but you're going to be protected at this strike price. So when the long strike price kicks in, from that point on, your losses are going to be capped. This position is called a short put spread. Something similar to a call spread, but the opposite. In this case, the structure is you sell, so you're short one out of the money put at KS right here. You're long one out of the money put at KL, which is at a strike price that's lower in price. And your max profit is going to be the credit you receive, PS minus PL. Your max loss is going to be the width of the spread minus the credit you received, because this can expand all the way to the width of the spread, because this starts losing money 1-to-1 with the stock at expiration, but the losses are capped at the price where your long put starts kicking in. The break even is going to be the strike price of the short put minus the credit that you received, PS minus PL. So if you look at this position, you can notice a few things. Number one, this is a bullish position, even though it's made up of puts. Number two, time passing is going to be beneficial to you, because let's say the price is here and it stays here and time starts passing. If it expires right here, you're going to collect your profit here. And that's it. Once it expires worthless, then the credit is yours to keep. And keep in mind, the max profit that you can have is the initial credit. If it starts going much higher than where you were, you're not going to be making more money. However, this dashed line representing the current profit and loss is going to be very, very close to the price, to the solid line, which represents the profit and loss at expiration. So if there's, for example, a few pennies left to make here, because this spread is trading at 5 cents, for example, and though that's all the profit you're going to make if you hang on to that position. Because of this, at that point, it might be beneficial to you to free up that capital, to close this position, and to accept a profit that's not going to be max profit, but is going to be max profit minus a few pennies that you are not going to get, but that would have represented holding on to this position for a very long time. So you are bullish when you put on this position. So this position is initiated for a credit on a single transaction. All the short put and the long put have the same expiration and the same number of contracts. This is a bullish position, as we were mentioning. This position is closed with a buy to close order on a single transaction. And again, you could manage these legs separately, but usually what happens is you open it with a single transaction and you close it with a single transaction. It goes in as a spread, it comes out as a spread. This is what a short put spread is. The Greeks will be partially offset because of both legs. So when you sell a put, you have positive theta, so positive time decay. Time passing is beneficial to you. However, because of the put that you had to buy to cap your losses, this is going to start decaying. So time decay for this one is negative, for this one is positive. So for this one it's positive, for this one's negative. So the overall time decay is going to still be positive, but it's going to be reduced by a lot because you have both legs. And the same thing happens to all the other Greeks. For example, deltas, if you think about the deltas of a short put, and let's say, for example, we sell the 20 delta put, we're going to have plus 20 deltas. However, since we had to buy the long put here, and let's say we bought the 15 delta put, we're going to have 20 positive deltas here, and then 15 negative deltas because we're buying a put. So we're going to have a total of 5 deltas altogether for the whole position. So if you only sell the put, you have 20. If you sell the put spread, you're going to have 5. That's what it means when we say that the Greeks are partially offset because of both legs. At expiration, if the price is completely out of the money, so it's going to be higher than the short strike price for the put, then the spread's going to be worthless, so you're going to keep your max profit. You're going to keep your initial credit, and that's going to be your max profit. If it's at the money, which for spreads, it means that it's in between the short strike price and the long strike price, then you're going to be assigned on your short put, and being assigned on a short put means that you're going to be assigned stock. So if you had one short put here, you're going to be assigned 100 shares of the underlying, and you're going to have to pay this price. And since it's trading at this price, at a price that's lower, then you're going to be realizing here a loss. But this loss is going to be offset by the credit that you received initially. So you have to look at your break even and see whether you made money or you lost money. Now, if your spread expired fully in the money, which means lower than the strike price of the long put, then you're going to be in the money for both. You're going to be assigned stock at the short strike price, and then you're going to be able to exercise and sell stock at the strike price of the long put, which means you're going to be buying at this price and then selling at this price, which is going to make you realize a loss between KS and KL. However, this loss is going to be offset by the credit that you received, leading to the max loss, which is the width of the spread minus the credit that you received. Okay, so if it expires fully in the money, you're going to be assigned, and then you're going to exercise your long put. We have a few advantages. Clear max profit and max loss. So you know you don't have any open-ended exposure. You know your max profit, you know your max loss. You have positive time decay, even though it's offset because you are selling a put and buying a put, you still have positive time decay. It gives you access to expensive underlyings. So, for example, if you have an underlying that's trading at $2,000, you will need a lot of money to put on a position there. However, if you just put on a short put spread, you only need to have the money to cover your max loss, which is going to be the width of the spread minus the credit that you received. And finally, there is no need for the highest level of approval for options trading. So you don't need, because you're not selling anything naked, you're covered at all times. You don't need the approval to trade naked options. Now let's do an example for a short call spread. We're going to have a stock that's trading at $2,000, and we're going to have a call that's trading at $50, which is the $2,100 strike price. And then another call that's the $2,105, so $2,105 strike price. This call is trading at $48. So what we're going to do is we're going to establish a short call spread. So the 2100, 2105 short call spread, we're going to initiate it for a credit of $2 because it's $50 that we got minus $48 that we had to pay. The total is going to be $200 because it's 100 shares per contract. The total buying power reduction is going to be $500 because that's the width of the spread and that's your max loss. But we have to subtract, we have to take into account that we received the credit, so we received $2, so it's minus the credit. So the total real buying power reduction is going to be equal to the max loss. It's going to be equal to $300 in this example. The max profit is $200, the credit that you received, and the max loss is $300. Now, it doesn't matter that this underlying is a very expensive one. This might be a stock that's trading at around $2,000. It doesn't matter. Your risk and your reward are $200 is your max profit and $300 is your max loss. This is a very interesting feature of vertical spreads. They allow you to take on some position not having to put on a lot of money to have this position on. The break even is going to be 2102. Why? Because you have this strike price, which is KS, the strike price where you're short, and you have to add the credit that you received. So 2100 plus $2. So it's right here. 2100, which is the short strike price, plus the credit that you got, which was $2. 2100 plus 2, the break even is 2102, this point right here at expiration. So let's compare the capital that we need to put on different bearish positions in this case. If we were to sell 100 shares short, you would need $2,000 times 100. So you would need $200,000. If you have a margin account, which you actually need, you might be able to use only half because you usually get 2-to-1 margin ratio. So you probably wouldn't need the $200,000, but you would need $100,000 for sure. If you want to sell the $2,100 call, okay, so this one, and you don't want to sell a call spread, you only want to sell the call, then you're going to be margined. Your buying power reduction is going to be equal to the amount that the broker requires. And in this case, for the most part, if you have a regular margin and not portfolio margin, you're going to be looking at somewhere around 20% of the notional value of your position. If you have one short call, this is covering 100 shares. So we'd be talking about just around 20% of the notional value of your position, which means the 2100 strike price, which is going to be 20% of the 2100 times 100 divided by 5, so 20% of that. And then we have to subtract the distance between the strike price and the current price. It's going to work out to pretty much a number that's very close to $40,000. So approximately $40,000 to sell one $2,100 call. So if you sell the 2100, 2105 call spread, you're going to have to put up $500 for the width of the spread. But remember, when you put it on, you receive an initial credit. So in reality, you are actually putting up the max loss, which is going to be around $300. So notice here how we're comparing in order to be able to put on a bearish position. We can sell the stock short, which is going to be 200,000 or 100,000 if you use margin. If you want to sell a single call naked, you will need around $40,000. And if you want to sell the call spread, you only need $500. And actually, you only need $300 because you get the credit back. Okay, so you can see the difference, and you can see how this type of position allows you to establish a bearish position where you would need a lot more capital if you didn't have access to this type of position. Now we're going to take a look at an example for a short put spread. What we have is a stock that's trading at $1,600, and we have a put at $1,505, that's the strike price, that's trading at $35, and another put at $1,500, so that's the strike price for the long put, and that one's trading at $33. So what we're going to do here is we're going to sell the put that's at the higher strike, and then we're going to buy the put that's at the lower strike price. So we're gonna be selling this one, and we're gonna be buying this one. Okay, so this is going to be the 1505 1500 short put spread that's going to be initiated for a credit of $2. So a total of $200 in credit, because it's 100 shares for every contract. The total buying power reduction is going to be $500, but we got a credit when we initiated the position. So it's $500 minus the credit. So the total buying power reduction is going to be equal to the max loss, and it's going to be $300. Max profit, $200. Max loss, $300. The break even is going to be 1503. Why? Because we have this strike price. So at expiration, this is going to be the place where you start, where your profits start going down, and you have a cushion of $2, which is what you got for as a credit. So 1505, which is this, minus the credit that you got, which was $2. 1505 minus $2 is going to be equal to 1503, which is the break even right here. Now the capital required to be long, so this is a bullish position. So we're going to start comparing ways to have a bullish position. If I want to be long 100 shares, I have to buy 100 shares of a stock that's trading at $1,600. So you're going to be putting up $160,000. You need 160K just to initiate the trade. Now, if you have margin, you might be able to only need half of this because you have a 2-to-1 ratio, margining ratio. But still, we're talking about $80,000. If you only want to sell the 1505 put, you need, if you have regular margin and not portfolio margin, you're going to need 20% of the put. Okay, so you're going to have a requirement of putting up $30,000, so approximately $30,000 to sell one put. Now, if you don't have the margin, or you're not approved to sell naked puts, then you can still put it on, but you're gonna have the need for a cash secured put. In that case, you're gonna have to put up all the money that you need all the way to zero. So you would need basically $150,000. But here, let's even assume that you have permission to sell naked puts. You will need about $30,000. Now, if we compare these requirements, these capital requirements, to what we need for the short put spread, for selling the 1505, 1500 put spread, you would need the width of the spread, right? And that would be it, $500. And actually, you still need to subtract the initial credit. So in reality, you would need something closer to $300 to maintain this position, okay? Because you got the credit, and that credit is yours to keep no matter what, okay? So you can see how using a vertical credit spread allows you to access these types of underlyings with very little capital. Now let's go to our platform and take a look at some examples with real data. So now we're here on our trading platform, and we're looking at Salesforce, which has a ticker symbol of CRM. It's trading at around $176. What we're going to do is we're going to open up the July expiration. So we have 51 days to go. And what I'm going to do is I'm going to be selling a call spread, and I'm also going to be selling a put spread on this company. So I'm going to go to the 185, and what I'm going to do is I'm going to be using the menu. So sell, and then I go to vertical, and I already have the long leg pre-populated, so it just takes the next strike up. So here I am doing a vertical spread. I'm selling the July 2020 for CRM, and I'm receiving 163 as credit. So if I analyze here, what I have is I'm selling one of the vertical CRM. I'm selling the 185 190 for 164. My max profit is $164. My max loss is $336. So I'm talking about a buying power effect, which is going to be equal to the max loss of $336. Okay. So what I'm going to do is I'm going to send this to the Analyze tab. Okay. And now we are going to go back, and we're going to do the same thing on the put side. I'm going to take the 165. So I'm going to be selling a vertical spread. Okay, sell vertical, and it takes the next strike price for the long leg. So now I'm selling the for July 2020. I'm selling the 165 160 put spread for 129. Same deal. 129 is my max profit. 371 is my max loss. Okay, so I'm gonna analyze this trade, and I'm going to analyze the other trade as well. So what I have here, first let's start with the credit spread. Okay, so what I have here is a short call spread. Okay, so you can see the blue line is the expiration line, the profit and loss at expiration, and the purple line is the profit and loss right now. So as you can see, we just put it on. This is where the price is. This is where our short is, 185, and this is where our long call is. So this is a bearish position. Okay, you can see here the delta is -7, so it doesn't have a lot of deltas because it's a spread. It's a vertical spread. Okay, so it's the 185 190 short call spread. I can make 165, and then I can lose 335. So this is what it looks like. It's a bearish position. Now if we analyze the short put spread, it's something similar, but it's on the downside is where these puts are. The short put at 165 and the long put at 160. So here I am short the 165 160 put spread for 128. I can make $128. I can lose 372. Okay, so this is how it works. If I start simulating the passage of time, you can see how this is the short put spread. Look at the purple line. It starts going closer to the actual blue line, which is the expiration line, until at expiration it merges with it. Okay, same with the call spread. If we look at the purple line, which is the line today, and if we assume nothing happens to the price, then as time passes, you're going to start getting closer to the P&L line that is the one at expiration. Now, why is this important? As you can see, as time passes, your position, your purple line starts going higher. So you start making money as time passes. So that means that you are long theta or long time decay. You benefit from the passage of time. Okay. Now, another thing, the last thing that I'm going to mention about short vertical spreads is that if you put the two together, you're going to have another position, which we're going to be talking about very soon, which is an iron condor. So an iron condor is a short call spread on the upside and a short put spread on the downside. Okay, but in this lesson we talked about a short vertical spread, so a vertical credit spread, and we talked about vertical call spreads and vertical put spreads, and both of them being put on for credits. So I hope that this lesson was interesting, and that now that we saw the other side of the coin, not only can you now put on debit spreads, you can also put on credit spreads, and you know more or less how they work. Those two types of trades, those two types of positions are complementary to each other. So you're going to be able to take whatever you need when you're trading, and you're going to be able to apply these concepts to your own trading. Thank you very much, and goodbye.